Hello and welcome to another PV-Tech Newscast coming up in this week's programme. Exclusive on the latest quarterly results from the top Tier 1 Chinese manufacturers, a report on European firms threatened by the solar industry shake-up, and installed capacity in the Asia-Pacific region set to hit 4.8 gigawatt. Despite their low-cost position, 10 Tier 1 Chinese PV manufacturers all reported losses for the quarter. Price declines outstripped cost reductions as overcapacity continued on a weak demand environment. With over 50% of PV manufacturing concentrated in China and the industry struggling to cope with overcapacity and rapid price declines, there's not a better time to gauge the health and direction of the PV industry. Warren Major reports.
Many manufacturers had pre-guided lower than expected shipments and revenues as the key German market failed to pick up in the third quarter. Installations there were down almost 50% compared to the first 9 months of the year. However, Yingli Green's figures reflected that were it not for inventory write-downs, the company would have been profitable in the quarter. The company has been relatively immune to shipment weakness due to its proximity to the Chinese market. Also standing out from the crowd in the quarter was CanadianSolar. In contrast to rivals, CanadianSolar guided fourth quarter shipments to be in the range of 340 to 360 megawatt, a strong sales pipeline roughly in line with Q3 shipments. The company said inventory levels at the end of Q3, valued at $407 million, had already been shipped in Q4 and did not have to sell any inventory at discount. While industry leader Suntech did indeed meet quarterly expectations, the company guided a 20% shipment decline in Q4. The company disclosed a cost reduction program that includes recapturing $200 million in cash flow, but the company still has $2 billion of net debt and negative cash flow from operations to claw back. Some financial analysts thought this may be too little, too late, given the company's $2 billion of net debt. A negative cash flow from operations combines to an approaching convertible bond repayment that would keep the company on loss-making for much of next year. The company also suggested there could be an asset write-off between $500 million to $1 billion. Due to market conditions, the majority of manufacturers said they would be halting planned capacity expansions in 2012, at least until market conditions improve. Hanwha, SolarOne and China Sunergy are now focusing efforts on moving production via upgrades to more advanced process technology in an effort to remain competitive. The majority of firms that reported results this week expected the tough market conditions to continue through the fourth quarter of this year and the seasonally weak first quarter of next year. With European markets expected to continue weakening next year and the fact Chinese firms are so heavily dependent on the region for business, there's now a rush to seek out more business from emerging markets such as the US, India and indeed China itself.
Over the coming months, the solar industry is set to experience its own version of natural selection as surplus capacity and falling prices triggers a significant reduction in the number of companies in the marketplace, according to a new report. Bank Sarasin claims that this shake-up will actually benefit the industry in the long term by ridding itself of the weaker companies. Overall growth prospects will improve, with new sales, markets and additional applications for PV, encouraging newly installed capacity to rise by an annual average rate of 18% between now and 2015. Small and medium-sized companies are likely to be the major victims, while their internationally diversified and vertically integrated rivals, such as Suntech, First Solar and SolarWorld, are benefiting from the changing landscape. European companies appear particularly vulnerable to the possible cull due to the expected stagnation or even contraction of the PV market on the continent. Among the firms likely to be affected are household names Conergy, Qcells, Solar-Fabrik and Sunways. A similar pattern is likely to emerge in the thin film sector. Over the last 12 months, the number of companies in the thin film industry has reduced by a third, leaving just 100 remaining active. Financially strong corporations such as First Solar, Sharp, ShowaShell, GE and Hanergy were said to be the likely successful survivors. The trade dispute between the US and China took a turn this week as many Chinese suppliers reconciled themselves to the US placing duties on modules shipped based on previous cases in other industries. Though the public spat continues with claims and counterclaims, several Chinese firms are already planning ways to get around the problem by shifting some production outside of China to avoid any expected duty penalties. Companies such as Suntech already have small module assembly lines established in the US, but others such as Canadian Solar have operations in Canada that would be ramped to supply modules into the US market. Canada itself could be the beneficiary of a mini boom in manufacturing, having already attracted suppliers to the region due to support for solar in Ontario. And finally, some good news. An end-of-year surge in the number of utility-scale PV installations in China and India is expected to result in installed capacity for 2011 in the Asia-Pacific region reaching 4.8 gigawatt. Total installations for the final quarter of the year are expected to be 2 gigawatt, a 39% increase quarter-on-quarter, and a 130% year-on-year capacity rise. China has been driving this growth, accounting for nearly half of regional demand in Q4, and by the year's end will have connected close to 2 gigawatt. Not only is this total the largest in Asia, but it will also top the 1.6 gigawatt figure forecast for the US. Outside of China, demand is being driven by already existing or planned national incentive programs in countries such as India, Japan, Thailand and Malaysia, with the latter two expected to account for an additional 700 megawatt of demand in 2012. Despite all this success, market constraints and downstream access issues still exist in most countries in the region, presenting a headache to potential project developers. However, the SolarBuzz report noted that these challenges are unlikely to deter companies, given the potential of this new regional market opportunity. Well, that's it for another newscast from PV-Tech. Thanks for watching. We'll see you next week.